Great. Well, good afternoon, everybody. We'd like to welcome you to our second quarter market and portfolio update. We've been doing these now for several quarters in a row, and we're starting to get a lot of feedback from you all that you're enjoying this communication. So we hope you enjoyed today's presentation as well. Steve is really focused today on talking about some updates to what we're doing with the portfolio. But I think it's important to know that there are a lot of other planning opportunities that we're starting to speak with clients about in light of the changes with the Biden administration. There's some talk of changes in estate planning, numbers in how much estate tax can be accumulated without paying tax. There's some talk about capital changes in capital gains. So there are definitely things we want to be talking about with you with the next quarter. So when you meet with your advisor, we're going to, please bring up those topics. I'm sure we'll be bringing them up as well. So with that, just a little housekeeping. If anybody has any questions during the presentation, we really want this to be interactive. There's a chat function at the bottom. Just type your questions in, and we'll get those to Steve. I'll monitor those. So with that being said, Steve, take it away.
Thank you, Diane, and thank you all for joining us today. I hope this is informative. What we did want to do today is discuss what's been happening in the markets, specifically what happened, especially in the first quarter of this year, and how that is guiding our what we're doing to portfolios and the asset allocation moving forward in the second quarter of this year. So first, I'll give a quick update on what's happening in the markets, both what happened in the last quarter as well as what's going on currently this quarter. Then I'll discuss how that impacts our portfolio and investment strategy. And then, of course, at the very end, we'll do Q&A. But again, I encourage anyone who has a question to ask as we're going. So, I actually grew up, I went to high school in the 80s. I love the 80s. I'm not wearing an 80s power yellow tie at the moment, but maybe I should have. But in the 80s, we had one of my childhood favorite movies, The Karate Kid. As many of you may have remembered that movie, it was, Johnny Lawrence against Daniel LaRusso. And we also in the 80s had, especially in the mid 80s, had what was considered to be the height of the Cold War with a very large Eastern power, that would be Russia. The other thing that happened in 1984 specifically is that we had gross domestic product growth in the United States on a year-over-year basis of over 7%. GDP growth has never been over 7% since. That was the highest it's ever been in recent history. So here we are in 2021, and we now have Cobra Kai, which is a very successful reboot of the Karate Kid franchise. In case any of you haven't already heard of it or know about it, is it available on Netflix? I do highly recommend it for those of you with nostalgia for the 80s, such as myself. We also have rising tensions with a very, very large Eastern power, this time China. And according to most economists, as well as Wall Street analysts, this could be the year, and probably will be the year, that we actually see gross domestic product growth in the United States over 7%. Again, not seen since 1984. So, why is that insignificant? Well, it's significant because that means our economy is really humming along and has recovered dramatically from the massive slowdown we saw last year due to the pandemic. One of the things we also have to talk about, of course, is the pandemic itself. There is a lot of optimism in the markets about the progress that we have seen, both in this country and abroad, about potentially reaching a herd immunity status, whereby approximately 70 to 80% of this country's population will hopefully be at that herd immunity zone by midsummer, perhaps June of this year, which really means things can get back to normal, which I think everyone is looking forward to. and putting, some of the massive difficulties many of us faced last year with COVID-19 behind us. Now, the other thing that's also happening is our government, as well as many other governments across the world, have been throwing a lot of money at this problem. Massive fiscal stimulus, massive spending bills to avoid some of the economic disasters that might have occurred without that spending due to the pandemic. So that's one thing certainly that the market is enjoying, because there's the old saying, don't fight the Fed, meaning when the Federal Reserve is being very accommodative or dovish, so to speak, you want to be going with that. You don't want to be fighting that trend. And conversely, if the Federal Reserve is trying to put their foot on the brake for the economy, in other words, they're being hawkish or raising interest rates, you don't want to fight that either. Usually that's time to pull back a bit from the market. But right now, the government really is about as dovish and stimulative as it can possibly be. We haven't seen the Fed like this, even after the great financial crisis, in 2007 and 8, the Fed wasn't as stimulative as they are being right now. So again, that helps support asset prices, and we'll talk about that more in a few minutes. But obviously, one of the concerns that we face when we have a massive amount of money sloshing around the system is the specter of inflation. And we definitely have seen inflation picking up. We know inflation is generally the enemy of bonds, and bond prices have actually not performed well. The Barclays aggregate bond index is actually negative for the year. So the question is, do we have to worry about even more inflation in the near future? So we'll talk about that. And of course, inflation is directly related to interest rates, and we have seen interest rates rise recently, hence the negative return of the bond market. And the question is, how much more will they rise, or have they risen as much as they probably will rise for this year? That's another thing we need to take a look at and dig into a bit. And I think, lastly, I think a key observation that I think we all have to be aware of is that, we've had some extraordinary U.S. equity market returns in the last couple of years. I mean, 2020 had fantastic numbers. 2021 is looking good. So, one thing to keep in mind is that I think it makes sense to moderate return expectations going forward. And potentially take some profits. So we'll talk a little bit more about that as well as we go forward. So those are the highlights. So let's dig into some more details here. I mentioned the pandemic. So, and hopefully everyone can see my mouse moving along on the screen. But really, since the start of this year, we have seen a dramatic decline, both in the number of confirmed cases of COVID-19, as well as the number of fatalities. And a lot of that is attributable to the wise decision, not just by our government, by also many other global governments, to actually start vaccinating the most at-risk populations first, which would be the elderly, because that is where the death rates were actually quite high and concerning. And so by doing that strategy, that has actually really reduced fatalities to quite low levels, and it seems to be that we expect those levels to continue to drop. And on the right side, again, and this is what the market is really looking forward to, is really when can we get truly back to normal? But quite frankly, many companies are already acting like we're back to normal. But this gray zone here is what's considered sort of the zone of herd immunity, and the bars here kind of show a few things. Well, one, it shows what's our estimate of how many people who have been infected already. And then the couple other bars show there's also the population that's both been infected and vaccinated, and then those that have been vaccinated only. And you can see the combination of those things by probably midsummer, given the way the trend looks now, we should solidly be in this gray area, which would really be where we can feel comfortable talking about the concept of herd immunity and talking about the concept of actually getting back to normal. Now, I would say that certainly a risk to the markets, it would be if we actually don't reach what would be considered herd immunity by the summer. There are certain things going on right now. I mean, there's been a massive uptick in cases in India. and that's obviously problematic. If vicious variants of the disease can spawn from that, that could be problematic. So obviously these things are, totally unpredictable and hard to determine, but something to keep an eye on, because again, the market is expecting this country at least to be back to almost normal by midsummer. So, another thing we talk about, the massive hit to our economy because of the pandemic, and then we talk about what was known as a V-shaped recovery. So when people talk about a V-shaped recovery, this is really what they're talking about. This is your V, right? This is actually showing the global economic activity before the pandemic, and then what happened during the pandemic, and what is actually now happening now, as well as what's expected to happen. So we had one of the fastest recessions we've ever had in this country because of the pandemic, and we've actually also had one of the fastest recoveries we've ever had. And interestingly enough, the market played right along with that. We had one of the fastest declines in markets we've ever seen. We had basically a 35% drop in the S&P 500 in a very, very short period of time. And then we had a dramatic rise in the S&P 500 once we got through what was considered to be the worst of the pandemic news. So, this is really showing that the economy is pretty much almost back to where it was prior to the pandemic, which is an incredible pace of recovery. Normally, it takes the economy much, much longer to get back on the footing, the pre-recession footing. Usually years, but in this case, it's really almost months. Just to talk about, and how did that play out in sector, and when you look at, the various areas of the markets. I think this is an interesting slide. So what this shows, if you take a look at various sector and styles of investing, this is what happened in the first quarter. You can see, well, interestingly enough, cryptocurrency, or as measured by Bitcoin, returned over 100% in the first quarter. Energy came roaring back in the first quarter after being decimated as a result of the pandemic. Energy came back in a strong way. The price of oil went up, over 20% in the first quarter. Bonds, though, as you can see on the other end here, bonds were negative in the first quarter, as was a traditional hedge against, hedge against equity volatility. Gold was also negative in the first quarter. The S&P 500 in general was kind of in the middle here between sort of a lot of these other categories. So, but one thing to keep in mind is that the cyclically sensitive sectors that you would expect to perform well when the economy rebounds did exactly that. Cyclically sensitive meaning energy and financials and industrials. Right? They actually did do exactly as what we would expect them to do in the first quarter. And now the question is that going to continue, or are we going to see this balance out a little more in the second quarter? So let's talk about the market for a second, and we'll use the S&P 500 as a good proxy for the market. And what this really shows here, this 87% number, is the staggering rise that we saw in the market from the 2020 low, that was March 23rd of last year, to basically, I think this is as of a couple of days ago, the April 26th close, we had an 87% rise. That has basically been one of the that is the fastest rise or increase in the market ever in basically a little over a year's time. That's a staggering number. I mean, a lot of people are happy with an 87% return after like 10 years, let alone 1 year. So that's really been something that has been hard to reconcile. How can we have such a massive market performance, kind of as we suffer through this pandemic? And again, the short answer is, well, a lot of it is because the market's already looking forward to being through the pandemic. But the other answer is that the market's really looking at company earnings, because it's really about the earnings of companies that determine whether or not the market trades at justifiable levels. And earnings in 2021, according to most of the analysts who cover the companies in the S&P 500, are actually supposed to reach a record level, meaning 2021 should be a year that we see the highest earnings of the S&P 500 in history, better than 2019, and obviously better than 2020 because 2020 we had the COVID hit to earnings, and so but even better than 2019, and 2022 earnings projections are actually expected to be even better than 2021. So the market is really looking forward to heightened earnings expectations, which means that in some ways the market can kind of grow into its multiple. Because if earnings do come in at record levels, then that can sometimes justify these high forward PE ratios that we're seeing. Another thing to look at here is the big difference that we saw during the dot-com bubble, and that's here. This is right before the dot-com bubble in March of 2000. The 10-year Treasury yield was trading over 6%, right? Now, the 10-year Treasury yield is basically trading at well over at almost 5% less than that. So that's a big difference, and the reason is because that makes it very difficult for investors to find a reasonable investment alternative to stocks, right? So, one thing, by the way, I also should mention that, we talk about how high the market is. Well, the PE ratio, as again, on a forward basis right now, is over 22. Now, the only comforting factor is that it's actually been higher, but only once in history, and that was right before the dot-com bubble when it actually was over 25. So we're not there yet. If we get there, that might be a little scary, but nevertheless, this is still a pretty high number. But again, part of the reason that there's a big difference between then and now is the dramatically low level of interest rates. So I think it was Warren Buffett who might have said it best. He said, "Hey, listen, if you can tell me that if I invest in a 10-year investment where I'm guaranteed to lose money after inflation, for 10 years straight, why would I ever do that?" And what he's really referring to is the fact that if you look at the inflation rate today, which is hovering right around 1.5, 1.7%, he's saying that after inflation, you're basically getting nothing in return for investing in a 10-year Treasury bond. So that kind of goes to the acronym that you might have heard about, the TINA, T-I-N-A, which is there is no alternative to stocks. And that's one of the things that's certainly supporting the market, the market levels that we're seeing today. So we talked about the PE ratio, and obviously that's pretty high. Let's look at other valuations to see if there's a way we can figure out if the market's truly off kilter in terms of being a little high. The cyclically adjusted price to earnings ratio, better known as the CAPE, what does that do? Well, that tries to actually smooth out the PE ratio and look at it over a 10-year rolling time period, which can eliminate, short-term fluctuations, cyclicality, things like that. So even if you look at that measure, the average in the last 25 years of the CAPE is 27.6. Right now we're at 37.5. So that's not really telling us anything to give us comfort. That's high as well. The dividend yield of the market. The dividend yield over the last 25 years has averaged around 2%, meaning that's the average amount of dividend that you would get from investing in an S&P 500 stock. Right now, that's actually a lot lower. It's below 1.5. Price to book, another popular measure of how to look at a company's worth. 25-year average, that's about 3. Now we're over 4. Price to cash flow, pricing companies based upon how much cash they're throwing out. 25-year average is around 11. We're over 16. Unfortunately, all those are telling us, yes, the market is overvalued. However, there is one measure that's kind of interesting, which is what I like to look at, because this kind of gets into why interest rates matter so much today, and that's what we call the earnings yield spread. What's the earnings yield spread? Well, essentially, the earnings yield spread is taking an investment grade bonds yield, and investment grade meaning anything that's above junk level debt, and it's taking the earnings yield of the S&P 500, and I'll explain how to calculate that in a minute. You take the earnings yield of the S&P 500 minus the bond yield to get this number, right? And the 25-year average, it's basically 0.08%, or it's basically 0. And now we're actually right now at 0.88%, or close to 1%. And that is actually much higher on average than it's been historically. So what that's telling us is that based upon that measure, the market is not overvalued. So let's dig into that number a bit, because I think that's kind of an interesting way to look at the market, and it kind of explains the dynamic between stocks and bonds and the trade-offs that we look at. So let's, first of all, to calculate the earnings yield of the S&P 500, first we have to know, well, what is the S&P 500 expected to earn on an earnings per share basis in aggregate next year? So let's go to Goldman Sachs. Our friends at Goldman Sachs are very good at predicting these things. So they predict that in 2021, the S&P 500 earnings per share estimates on a whole will be $181, meaning the S&P 500 stocks in aggregate should earn on a per share basis $181, okay? So we take that number, and this is as of today actually. We take that number and we look at what the S&P 500 is trading at. It closed today at 41.86. Now we also have to take that bond yield we were talking about, right? What is a typical investment corporate bond yielding right now? We'll use this Moody's seasoned rate, about 3.6% as of a few days ago, okay? So those are our factors. So we take that, the earnings of the S&P divided by the level of the S&P, and that gives, and we convert that to a percentage. That gives us the earnings yield of the S&P at 4.33%, right? 4.33% minus this 3.58% that you can get from an investment grade bond gives you that earnings yield spread, which is kind of that number we were talking about in the chart over here. So basically, that's how we arrive at that calculation. So then the question is, well, what has to happen for that earnings yield spread to get back to its average? In other words, how much do interest rates have to rise? Well, let's figure it out. To get to that 25-year average, yields would have to rise by about 67 basis points. What's a basis point? A basis point is 1/10%, so 0.67%. So basically, that would take this yield on a corporate bond from about 3.58% to 4.25. So in general, what this is kind of telling us is, if I'm an investor and I'm thinking, hey, you know, I'd really like to maybe put my money in something more safe than the equity market, what's that level that I'm going to feel compelled to start selling my stock and put it into bonds? Well, maybe around 4.25%. If I'm making 4.25% and taking way less risk, well, maybe I'll start to consider that. Maybe stocks won't be the only game in town then. So that's one number I think is important to look at and something to keep an eye on. And that's one of the reasons, again, because interest rates are so low, there aren't that many great alternatives for investors today. So I just wanted to dig into that number because that's the only number in those ratios we're looking at that says that maybe the S&P 500 isn't so overvalued after all. All right, I think I've talked about the valuations level enough. I'm not going to dig too much more into those numbers, but by all means, if you have any questions, please let us know. But a lot of people talk about, all right, well, you know, what should we do? So a lot of what we have to do, I think a lot of it depends on what's happening with interest rates, right? So back in the early 80s, again, one of my favorite decades, I mean, boy, I wish I bought a lot of those treasury bonds in those days when you could get a 15 to 16% yield on a 10-year treasury. Those days are unfortunately long gone, right? So this chart shows the yield that you could get from a 10-year US government treasury bond, which is considered a benchmark treasury interest rate. And the gray bar here actually shows what the real return is, meaning after inflation. So in other words, you take the yield minus the inflation rate, that's your real return. And as you can see, quite recently, especially last year, we essentially had negative returns from bonds because the inflation rate was actually a lot higher than the 10-year treasury bond was yielding. As a matter of fact, the 10-year treasury bond last year was yielding even less than 1%, hence the much more negative real rate figure here. So again, you know, if this stays this way, if interest rates don't really go up, the return that you're going to get from bonds is challenged, not that attractive. Right now, bonds definitely still have a place in portfolios, and if you're a more conservative investor, they definitely have a place because bonds can be a good alternative if the stock market gets rough. And there are certain areas of bonds that still provide at least a reasonable return, as we saw from corporate bonds, anywhere from 3 to 4 to 5%. International bonds sometimes offer some yields. Emerging market bonds, we think there's some opportunity there. But in general, this again justifies why equity prices are where they are. So I think when people ask about what's going to happen to the equity markets, I think part of the answer is, well, it really depends on what happens to interest rates and also what happens to inflation. So let's talk about inflation for a second. So definitely inflation has picked up a bit, right? And all you have to do is read the headlines about how housing prices are basically at the highest they've been since 2006. Lumber prices have gone through the roof, no pun intended. And so inflation has crept up. Real material prices has definitely come up. And the expectations of future inflation have come up as well. However, despite all that, inflation still on a historical level is quite low. Like this chart on the right here actually shows, inflation over the last 8 years or so. And, inflation is still close to some of its lowest points, right? So the question is that going to stay that way? And, I like to bring up the example of my good old Aunt Helga, who before the pandemic started, she would walk to her pharmacy and buy her prescription pills. She would, buy physical thank you notes and cards and send birthday cards and thank you cards, handwritten. She would never use a computer. But I'll tell you something, because of the pandemic, now my Aunt Helga can use a computer. And now actually she can send cards electronically that cost a whole lot less. She can order her prescriptions from her pharmacy on the computer and get them delivered, which actually costs a whole lot less for everyone involved, not just her, but also the pharmacy. So there's a lot of deflationary trends that have been accelerated by the pandemic. The global birth rate, which had already been in decline, actually is declining even more as a result of the pandemic. That's a deflationary trend. The acceleration of technology into our economy and the usage of technology by people in the world increased dramatically because of the pandemic. That actually is a deflationary force in regards to prices. A lot of people experienced, unfortunately, accelerated retirement or early retirement as a result of the pandemic. Again, another deflationary force. So I guess the larger point that I'm making here is that while inflation has picked up, and there are certainly some pockets where prices have really come up, especially in certain commodities areas, there are counterbalancing global deflationary forces that might pretty well keep inflation in check for the foreseeable future. So we're not too concerned about inflation right now. But obviously it's something to keep an eye on, but I do think it's important to point out these larger deflationary forces that kind of counterbalance some of the headline inflation numbers we're seeing that maybe people are paying a little too much attention to, because that might be more of a temporary blip. Now, there are definitely some other challenges that I think, both, our economy as well as the global economy is going to be facing. But particularly in this country, if you look at if you look through the, 60s and 70s and basically the top 10% of earners in the United States usually were responsible for actually getting about a third of all the income earned in this country, right? But starting in 1980 and ever since, that number has gone dramatically upwards. So now the top 10% of income earners in this country are actually earning half, or actually more than half, of all the income. Now, Why is that potentially a challenge? Well, that's potentially a challenge because if you look at the savings rate, right, the top 10% of earners, they actually save about 36% of their earnings on average, right? Meaning they spend 64% of their earnings and they save more than a third of it. If you look at the bottom 90% of earners in this country, they pretty much spend everything they get, everything they earn, right? So what does that mean? Well, that means that all that savings by the top 10%, who are, by the way, earning more than half of all the income, well, that raises asset prices because those savings are pretty much going into the market, right? And which supports equity prices. It actually supports bond prices. It supports any asset price that is something that people put their money in when they're saving. So if we see higher taxes, and there's a lot of talk right now about the Biden administration imposing new taxes, we probably will see some compromise in Congress over that, but inevitably taxes will rise. I think it's just a question of how much. Then it's definitely possible that this savings rate that we see from the top income earners might go down, especially with more punitive tax rates. So if that happens, that is not going to support asset prices, right? So a higher savings rate does support asset prices, a lower savings rate won't. So that's something to keep an eye on, and I don't think we're going to escape from this phenomenon anytime soon. Another challenge, we've been talking about how much spending has been going on, how our economy is awash in cash. Well, at some point, that's going to become a drag on our economy, and it's going to potentially show up in higher rates, right? I mean, right now, the current forecast is for our debt as a percent of gross domestic product to be soon to be higher than even after World War II, right? When we were in war times and we had, a pretty high deficit. Well, we're about to blow through that record level. Now, is that a massive problem right now? Perhaps, but perhaps not. And the perhaps not camp is subscribes to what's known as modern monetary theory, or MMT for short. What's MMT? Well, there's a certain camp of economists who believe that having a high deficit and a lot of debt doesn't really matter unless inflation is a problem. So basically, MMT's, if I could summarize it, basically says that inflation is the ultimate arbiter, and that inflation will tell you if you're spending too much or you have too much debt. But as long as you don't have a problematic inflation scenario, then spend away. Now, I'm not necessarily an adherent to that philosophy. I actually think there's some flaws there, but there is sort of that counterbalancing argument to why our debt shouldn't be something to be worried about right now until we actually see more inflation. And actually, the Federal Reserve has explicitly stated they'd actually like to see more inflation. They're encouraging it, right? So that's something to keep an eye on. But I do think that can be a challenge because ultimately, a high government deficit, higher inflation can be a drag on economic growth, which can also then be a drag on company earnings, which will then be a drag on market returns. And this gets to sort of a larger point, which was, I think we need to be prepared to anticipate perhaps less returns from the markets that we've experienced in the last several years. Sorry, this slide is actually just reiterating the fact that, across the globe, central bank balance sheets are really ballooning. The left side shows the Bank of Japan, which is kind of an outlier, but a little scary how much their balance sheets are. Also the Bank of England, the ECB, as well as our country, basically getting to levels that they haven't ever been at in terms of assets on their balance sheets. And again, that kind of reiterates the fact that that's not a problem that's going to go away anytime soon. As a matter of fact, it's potentially a problem that's going to just get worse. So, after all this talk, are things frothy? A lot of people ask, are we in a bubble? Are we going to, have a big meltdown in the markets, right? So Let's go back to our friends at Goldman Sachs. Well, they just came out with a piece about a month ago that talked about bubbles, and it said, "A guide to bubbles and why we are not in one." I can't say I agree 100% that we're not in one, but basically their point was they cited many characteristics of bubbles, many of which we are not actually experiencing now. So usually bubbles, for example, one characteristic is sometimes during bubbles you see lots of irregularities in reporting and numbers and accounting scandals. We actually haven't seen that. Companies are actually very above board in how they're reporting their numbers. We haven't seen any shenanigans such as that. And they cite some other examples. But so at least one of the major investment banks is saying that we shouldn't really worry about being in a bubble, although that's probably in their best interest to to make people think we're not in a bubble. Again, I talked about the Federal Reserve. The Federal Reserve is basically making statements that, they want to keep the pedal to the metal. They want to keep stimulating the economy, and they're not going to be happy until they're 100% sure that we are out of the mess that we were in because of COVID, that unemployment is down, and that inflation is actually ticking up. The CEO of JP Morgan, Jamie Dimon, this boom could easily run into 2023. Thanks, Jamie. Thanks for that thought. I hope that's true. But that's just an example of, there's sort of a give and take here between exuberance and caution. The one thing I like to notice, though, is that because there are a lot of people talking about the high levels of stocks and the high levels of equities, I think that's a good thing. I think when everyone is talking about how, oh my gosh, the market's great, it's going to go up forever, that's when you really have to get worried. So the more people who are talking about how the market is, that's sort of what's known as a contrarian indicator, meaning, as long as there's a lot of bears, that lowers the chance that we're going to have, something pretty scary happen in the market. Now, we talked a lot about the US, let's talk about international real quick, and I want to be sensitive to time, but one thing that we do want to keep in mind is that many portfolios we see are underweight international stocks. Now, why is that? Well, first of all, a lot of people just are more comfortable investing in US stocks, but more importantly, B, US stocks have outperformed international stocks pretty handily over the last 10 years. So unless you have consistently rebalanced your portfolio and kind of cut down on US and added to international, you probably have more US equity exposure than you should relative to international exposure. Now, why is that an issue? Well, it's an issue because US equities are probably some of the most expensive equities out there on a relative basis compared to the rest of the world. So this chart on the left actually shows the average discount of international stocks relative to the US. And basically, and this is as of a couple of weeks ago, this is showing on average that international stocks are about 26% cheaper on a relative basis than their US counterparts. And so basically what that is telling us is that if you are going to continue to maintain a healthy equity exposure, it's probably wise to make sure you have also a good international exposure, because international equities are not as expensive as US equities. And I think that's an important point. And on the right here, you can see, if you look at sort of the gray bars represent a range of valuations. So for example, this is showing, both the current PE, the 25-year average of the PE, and right here, and then the range. The gray bar is the range of that PE. So as we talked about, the 25-year average price to earnings ratio of the S&P 500 is about 16.5. Right now we're at 22.5. The range has been anywhere between 25 and 10. Okay, so again, this diamond here, way uncomfortably above the 25-year average. If you look at emerging markets, on average, that's been about 12, and now it's at 15, much more comfortably within the range. China, surprisingly, much more comfortably within the range, not dramatically overvalued at all. Europe is probably the most reasonably priced based upon its 25-year average. And Japan is actually lower right now on a PE ratio basis than its 25-year average. So that's one of the reasons that we are very conscious of making sure that we have good international or proper international exposure relative to benchmarks when we're looking at portfolios. Commodities. So we talked a little bit about how, you know, some real asset prices are going up. Despite that fact, commodity prices are actually low relative to historical standards. Now, this again, it's a similar chart. The gray bar shows the range of commodity prices, and the diamond shows where we are today. And the line here in the middle is kind of the average for those particular commodities. So you'll see a whole bunch of commodities are actually below their long-term average. Certainly some precious metals have come up and are a little above, but certainly within a reasonable range. So one of the things we actually think is really important and commodities, by the way, had a rough go of it over the last 10 years. They actually haven't returned much of anything, especially due to the dramatic decline in oil prices that we saw. But we actually think the commodity exposure is pretty important because commodities can serve as a good inflation hedge. So if inflation picks up, they can be a good thing to have. And also when the economy starts to pick up steam and, you know, it starts to, as it is now, you know, commodities become sometimes a lot more in demand. So that one of the reasons we're pointing this out is because we actually believe that portfolios should have some commodity exposure moving forward, where in the past we weren't that concerned about having commodity exposure. So a lot of information that we threw out there. So I think, you know, I just wanted to kind of sum up some of the key points here in regards to what that means to portfolios. So we do think it makes sense, and we will be we have made and will be continue to make trades to emphasize these points, to actually underweight U.S. equity, and particularly large cap U.S. equity. If you look at, you know, the cap sizes, meaning large cap is kind of like the S&P 500, and then, you know, mid and small are companies that are below that. Large cap U.S. are much more expensive on a relative basis than mid and small. So we definitely feel it makes sense to underweight large cap U.S. equity, and then add exposure to the more reasonably valued small and mid cap. And we actually have seen small cap stocks outperform pretty dramatically, both in the first quarter and at the very end of last year. And again, that's a phenomenon that happens when you do see strong economic growth. So smaller companies tend to benefit more in that environment. So we want to make sure we make the adjustments like that in the portfolio. Again, we talked about this with international equity. We do want to favor international stocks. Again, because of a valuation perspective, we think they're cheaper relative to the US counterparts. So we want to make sure that our portfolios reflect that. And again, we didn't talk about this in the presentation, but the other thing international stocks can do is serve as a great hedge against a weak dollar. And are we worried about having a weaker dollar? Yes. Because when you have large deficits and debt, as well as rising inflation, that can affect your currency, and that can make your currency weaker relative to other currencies. So we do want, and international equity is an excellent hedge against US dollar weakness. Why? Because if you own international equity, earnings in international stocks are usually produced in non-dollar currencies, you know, euros, yen. So that's good if the dollar is weak, because you're earning money in non-dollar terms. So that's one of the reasons we also favor international equity. One of the other things we're doing is we're slightly increasing cash. You know, I think I mentioned at the very beginning, and I think it was my old great uncle who said, no one ever went broke taking a profit. So we do believe that even though, you know, there might be some tax ramifications of selling assets that have appreciated so dramatically, sometimes you have to take a little bit money off the table and, you know, kind of get ready for a rainy day. So we are slightly increasing cash levels and what we consider to be alternative assets. Alternative assets are anything like commodities, gold, anything that tends to zig when US equity markets zag. So in essence, we do think it's wise to be a bit more defensive than usual, based upon the fact that as we speak, you know, the U.S. equity markets are basically at all-time high levels. The S&P hit a record yesterday. It traded slightly below that today. So at record levels like this, we do think it's prudent to potentially be a little bit more defensive. Another thing we also want to mention, and we do talk to clients about this a lot, and this can be especially important if you invest in individual stocks. We do favor stocks and money managers or investment managers who are ESG sensitive. ESG is short for environmental, social, and governance, which is kind of making sure that when you're putting your money into a company or investing in a company, that they aren't big polluters. They are responsible in regards to having good employment practices, non-discriminatory practices. They aren't hiring, really and taking advantage of underprivileged labor. So these are the types of things that have actually shown recently that companies that do score highly on ESG factors have actually produced better returns than non-ESG type companies. And we actually think that phenomenon will probably continue. We do see, especially investors from younger generations, very cognizant of wanting to invest in companies that are good for the world, as opposed to the ones that exploit the world, so to speak. Lastly, we did talk about how interest rates are so low. The bond market is kind of a tough place to be right now. So in order to make sure that we're prepared for that, we are going to focus a lot on credit. Credit meaning we're going to look for yields where we can get it without taking too much risk. Credit over duration, meaning we're going to emphasize corporate credit, de-emphasize government, because government, again, bond returns are pretty much after you take into account inflation, close to zero. So we want to make sure that we're favoring credit. Reducing duration essentially means reducing the average maturity of portfolios, making them shorter, because when long-term interest rates are quite low and we aren't really sure where they're going to go, but they possibly could go up, you don't want to be exposed to those long-term interest rates, because if interest rates do go up, you can lose more money if you have a longer duration than a shorter duration. So that's really what we're looking at in the bond in the bond holdings in our portfolio. So that's pretty much the summary of what we're doing in the portfolios this quarter. Hopefully that was helpful and informative. And of course, any particular questions that you may have, you can certainly talk to your advisors in regards to your particular portfolio. We'd be happy to have those conversations. And for that, after that, I guess I'll open it up to any questions.
Great. Thank you, Steve. So we still have a few minutes left. If anybody has any questions, we encourage you to type them into the chat.
I'm sure my presentation covered every possible question, but on the chance I didn't, again, we're more than happy to take questions later or have for future discussions.
Great. Well, not seeing any questions posted, we will give you all 10 minutes of your time back, and we appreciate you tuning in today, and we hope you stay well. We'll see you next time.
Thanks for your time today, everybody.
So long.